you apply for a loan. Or an insurance policy, you provide your income, your employment history, your financial information. You meet what you believe are the basic requirements. Then, a few days later, an email arrives. Application declined, no conversation, no negotiation. Maybe no explanation that actually makes sense. Just a decision. And somewhere behind that decision may be a scoring system you've never seen, built from data you may not even know was considered. You can't ask the algorithm why. You can't explain what it misunderstood. You can't tell it that one number doesn't describe your life. And when the decision involves your ability to buy a home, pay for a car, protect your family, or recover from an emergency, a number can become much more than a number. Welcome to Ethics Engine. Today, we're looking at the growing role of AI and automated decision systems in lending and insurance, and the quiet power they have over people's financial lives. Financial institutions have been using automated scoring systems for decades. Artificial intelligence isn't responsible for inventing the concept. But newer machine learning systems can process far more information and identify patterns that traditional models might not capture. In lending, a model may be used to estimate something like, how likely is this applicant to repay? The inputs can include traditional financial information such as income, existing debt, repayment history, credit utilization, and previous applications. Depending on the system and the jurisdiction, automated decision-making may also involve other information. The important thing is that the model isn't necessarily asking, is this person a good person? It's asking, how does this person's data compare with patterns associated with previous outcomes? That distinction matters. Imagine a bank has millions of historical applications. Some people repaid their loans, others defaulted. A machine learning system can analyze those records and search for relationships between characteristics and outcomes. It might discover that certain combinations of financial behavior correlate with higher repayment risk. The resulting model produces a prediction. Maybe it's a probability. Maybe it's a risk category. Maybe it's a score. And that score can influence whether a human reviews your application, what terms you are offered, or whether the application is rejected. Insurance works somewhat differently. Insurers estimate risk. For auto insurance, that can involve factors related to driving history, vehicle characteristics, location, claims history, and other legally permissible information. For property insurance, models can incorporate information about the property and its surrounding risks. AI can help process these variables and identify patterns across enormous datasets. The promise is efficiency. Instead of relying entirely on human judgment, algorithms can analyze information quickly and consistently. But there's a fundamental problem hiding inside that promise. Consistency doesn't necessarily mean fairness. A system can apply the same rule to everyone and still produce unequal outcomes. And sometimes the most important question isn't, does the algorithm make decisions consistently? It's, why did it make this decision in the first place? Imagine being 28 years old. You've been working for several years. You've saved money. You finally decide to apply for a mortgage. You submit everything. Then you're rejected. Maybe the explanation mentions insufficient creditworthiness. But you don't understand what actually caused the decision. Was it your debt, your credit history, something in your financial profile, a combination of dozens of variables? You don't know. And that uncertainty can be frustrating. Because financial decisions don't stay inside financial institutions. They affect everything around you. A rejected mortgage application can mean staying in a rental property longer. A denied auto loan can affect someone's ability to get to work. A higher insurance premium can make owning a vehicle more expensive. A lack of access to affordable credit can make emergencies much harder to survive. One decision can create another, and another. This is where automated financial decisions become particularly important. A person who is repeatedly denied affordable credit may have fewer opportunities to build wealth. Someone paying more for insurance has less money available for savings. Someone who can't access financing may struggle to invest in education, housing, or a business. The algorithm doesn't see any of that. It sees a data set. That's not necessarily a flaw. Algorithms aren't designed to understand your entire life. But humans are living inside the consequences of their predictions. And when the system gets something wrong, the person affected doesn't experience it as a statistical error. They experience it as another door closing. There's also a psychological difference between being rejected by a person and being rejected by a system. A human decision maker can potentially listen. You can explain that your income recently changed, that the missed payment was caused by an unusual event, that a debt on your record was the result of an error, that your circumstances are different now. An automated system may not know any of that. And even if a human eventually reviews the application, the machine-generated score may carry enormous influence. This creates a strange kind of power. The system doesn't need to speak to you. It doesn't need to justify itself directly. It simply produces a number. And that number can travel through an organization, from an application screen, to a risk department, to an approval decision, and eventually into your inbox. This is why transparency matters. If someone is denied access to something as important as credit or insurance, they need more than the feeling that a machine has spoken. They need meaningful information about the reasons. In the United States, consumer credit law already provides important protections. For example, under the Fair Credit Reporting Act and the Equal Credit Opportunity Act, creditors generally have obligations to provide specific reasons or notices in certain adverse action situations. And those requirements don't disappear simply because software is involved. But here's where technology creates a new challenge. A company may technically provide a reason while still leaving the customer confused. Your credit profile did not meet our criteria. That may satisfy a notification requirement in some circumstances, but does it actually explain what happened? That's the question technology is forcing regulators and financial institutions to confront. There are at least 4 major concerns. The first is transparency. Modern machine learning models can be extremely complicated. Sometimes even the people operating them can't easily explain why one particular applicant received one particular prediction. The second is bias. Financial history isn't created in a vacuum. People's financial opportunities are shaped by where they live, what opportunities they've had, their access to banking, employment conditions, housing markets, and historical inequalities. If those patterns exist in the training data, a model can potentially reproduce them. Even when protected characteristics aren't directly included, other variables can sometimes act as proxies. A zip code, for example, can contain information correlated with many characteristics. That doesn't automatically mean the model is illegally discriminatory, but it does mean that removing an explicit variable doesn't necessarily remove every pathway through which unequal outcomes can emerge. Third is contestability. If an algorithm makes an error, can you challenge it? Can a human review your case? Can you correct inaccurate information? Can you understand which factors mattered? And finally, dependence. As financial institutions automate more decisions, there is a temptation to assume that the algorithm is simply better than humans. Faster, more objective, more scientific. But every model contains assumptions. Someone chooses the data. Someone chooses the target. Someone decides what counts as a successful outcome. Someone decides how much weight different signals receive. The machine calculates, but humans designed the calculation. So, what should consumers be asking? First, Was AI or an automated system involved in this decision? People should not have to guess whether a machine played a significant role in a decision affecting their finances. Second, what information was considered? Not necessarily every line of proprietary code, but enough information to understand the major factors. Third, can I challenge the decision? There should be a meaningful path to human review when important financial decisions are disputed. Fourth, can incorrect data be corrected? An algorithm can be perfectly accurate at processing bad information. If the input is wrong, the output can be wrong with extraordinary efficiency. And finally, who is accountable? If a bank says the algorithm made the decision, and the vendor says the bank configured the system, who is responsible for fixing the mistake? The answer cannot simply be, the computer decided. A machine doesn't carry legal or moral responsibility. People do. That's why human oversight remains important even as automated systems become more sophisticated. The European Union's AI Act reflects this broader approach by placing stronger obligations on certain high-risk AI systems, including some systems used to evaluate the creditworthiness of natural persons. The principle is increasingly clear. The greater the consequences of an automated decision, the stronger the case for transparency and oversight. AI can make financial institutions faster. It can process enormous data sets. It can identify patterns humans might miss. It may even reduce some forms of human inconsistency. But efficiency creates a dangerous temptation. If the machine is faster, why question it? If the model is complicated, why challenge it? If the score is calculated from millions of data points, how could one individual possibly argue with it? That's exactly why the ability to challenge automated decisions matters. Because you are not a probability. You're not a risk category. You're not a number generated by a model. You're a person whose financial history exists within a much larger story. And if an algorithm gets that story wrong, you deserve more than an automated rejection email. You deserve a way to understand what happened, and a meaningful opportunity to say, that's not right, here's why. So here's today's question. Should people have a legal right to a clear explanation when an AI system rejects them for a loan or insurance? Yes or no, and why? Tell us in the comments. Because as more financial decisions move from human judgment to automated prediction, the most important question may not be whether AI is accurate. It may be whether people still have a voice when the algorithm says no. If the idea of an invisible system deciding your financial future bothers you, hit subscribe. We keep examining who holds the power.